Hello and welcome. I'm Justin Spencer Young, and today I'm doing an impromptu Tesla valuation. Last week I was doing a masterclass on valuation with a management team, and we valued several different businesses as part of the masterclass. But I got the question about what is the value of Tesla. Of course, it's on everyone's lips. Everyone wants to know, is the share price overvalued or overpriced, and what do I think? And I didn't have an answer because I hadn't done the valuation. So I thought, okay, let me go and get it done. So that's what I've spent a couple of days doing, and I'm going to run you through the valuation. Now, before I get into it, I want to recognize that I have used a substantial amount of the content that comes from Professor Damodaran of Stern University, and I have shown the link, and I'll put it in the notes below, to his YouTube video about his valuation of Tesla. So I've been a follower of Professor Damodaran for a long time from a valuation point of view. His methodology is sound. However, I have a few variants when it comes to valuing a company that he doesn't follow. And you might say, well, who am I to do it differently to Professor Damodaran, because he is supposedly the guru? But I have some different thoughts on this, and I'll share those with you. So the data is courtesy of Professor Damodaran. Thank you very much. And a lot of the thinking around the reinvestment requirement of Tesla, in other words the capex investment, is also taken from his insights. There's an area where we differ. Professor Damodaran is a stickler for detail around the capital asset pricing model and calculating cost of equity. I am not. I have another methodology, and I'll share that with you. I also have, let me put it this way, I have higher growth expectations when calculating terminal values. And again, I will look through that. So let's dive in. Let's start up here in the top left-hand corner, revenue growth. So this is data that Professor Damodaran uses, suggesting 35% revenue growth for the first 5 years, and then declining revenue growth towards 1.56 percentage points in year 10 of the forecast. Go and watch the video and he will explain why he declines to 1.56. I'm not going to spend time on that here. He also uses a tax rate for the first 5 years of 12%, and that increases to 25% in years 6 to 10. That relates largely to change in policy around subsidies, which impact or indirectly impacts the amount of taxes that the company pays. So I have followed the tax policy. I don't have any other information that's different from that. I have followed to a certain degree the revenue growth policy, and I've created multiple different scenarios based on different growth rates of revenues. Professor Damodaran uses a cost of capital of 6%. That's based on the CAPM, and again in the YouTube video he will take you through his calculations there. I use a cost of capital of 10%. Now, why do I do that? Well, I borrow from the work of Robert Shiller. Let me bring that into screen here. And here you can see this is the US market from 1870 to 2020, just about there and there. You can see major events that happen in the market, but the reality is there is a certain cumulative average growth rate that can describe this curve. You can see the formula here, and if you calculate this growth rate for the S&P 500 over the last more than 100 years, it turns out to be pretty close to 10%. 9.8 was the number I got, and for the sake of friendship, let's make it 10%. So I'm assuming that any investor in Tesla would expect at least the minimum return that they could have got from the market over the last 100 years. That's why I use 10%. I'll leave it at that. Let's go back to my valuation model. So you can see this is actually quite a significant difference between the WACC used by Damodaran and the WACC that I use. So the impact that's going to happen here is I am going to more heavily discount the earlier cash flows. Okay, so let's dive into this. The revenue numbers in this specific model are assuming a revenue growth rate of 30% per annum all the way through to year 10. Damodaran uses a terminal growth rate of 1.6%. I've chosen to use a growth rate of 7%. I'll come back to that just now. That's a big difference, okay? And that's the fundamental difference between the methodologies that we apply. So let's grow the revenues at 30%. Let's assume that they can grow at that rate. We can get an EBIT, operating profit, if you want, and you can see the operating profit margin is going from current margins 12.9% all the way up to 22% by year 10. So that's implying that there's more efficiencies that come with growth. We're taking the EBIT number, converting it to a net operating profit number, so you'll see that's adjusting for the tax component. We're subtracting out the reinvestment. Now Damodaran suggests that the reinvestment rate is that for every additional dollar of sales, they need additional $4 of capex. So that's what's happening here, is I'm growing the capex based on that assumption used by Damodaran, and that's taken from historical performance. So then we calculate our free cash flow, and once we've got a series of free cash flows, we're now in a position where we can calculate a terminal value. So this terminal value formula, you'll see what it does here is it takes from the last year of free cash flows and divides it by WACC minus growth. Now, because Damodaran is using a WACC of 6%, he doesn't have a lot of headroom to apply a growth of any significance here, because of course once your growth gets equal to or greater than your WACC, well then the terminal value calculation just doesn't work. So Damodaran certainly couldn't use a growth rate of 7% for the terminal calculation. WACC would just give a syntax error. So 1.6 is what he is choosing to use. I still think that it's very difficult to assume that you can grow your revenues for the next 10 years at 30% and then drop down to a terminal growth rate of 1.6. That's like falling off a cliff. Now, admittedly, the terminal growth or the terminal value is there to account for year 11 to infinity. So it goes a long way into the future, and we know that we can't grow at 30% into infinity. So you've got to take the edge off that growth. I'm going to use 7% in my calculation. So if you look at my terminal value formula, you will see Justin's WACC that's coming up here and taking the 10% minus Justin growth, that's using a 7% growth rate to get to the terminal value. So you see I give a lot more substance to the terminal value, in other words the long-term growth that exists or is potentially going to exist in Tesla compared to Damodaran. Alright, so next up let's go and discount the cash flows and the terminal value, and here you can see I've discounted these numbers using WACC. I've discounted the terminal value. We get an enterprise value here for Tesla, and less the debt, add the cash, gets you an equity value, and take the equity value divided by the number of issued shares, and you have a share price. And this is using Damodaran's data, suggesting that $963 a share is the valuation based on this forecast. Using my slightly different methodology, you'll see my valuation is a hair higher, $994 a share. So I constructed this scenario based on the fact that the current share price for Tesla is fraction under $1,000. Let's see if we can find that share price chart. Let's bring it in here. Let me make this a little smaller so that it fits onto the screen. There we go. So here we go. We're talking about, here's 2000 and September 2021, and you'll see here in November 2021 Tesla got up to 1,200 or so. We've had a couple of tests of that 1,200 number, and recently it's been in the zone that's anywhere from 820-ish, a couple of pushes below that, but 820 to around about 930 odd, in that kind of, let's call it the 900 zone. That's kind of where Tesla's operating at the moment. So I said, well, let me construct my valuation on the basis that I get myself to a value of pretty close to $1,000 a share. So that creates a scenario here. In order for Tesla to be at $1,000 a share, the assumption that is being made is that Tesla can grow its revenues at 30% per annum for the next 30 years, sorry, next 10 years. A terminal growth rate of 7% per annum using a WACC of 10%, and you have yourself a value of $1,000. Okay, so I guess you got to ask yourself, what is the possibility of achieving that? Well, the reality is that since the market believes that this is the share price, the market must believe that this is possible. And therefore, that's the value of Tesla. Now, I wanted to go and do some work around this in order to create some scenarios. So here it is. I'm going to zoom into our scenarios here. Let's get a closer look at what's going on here. So what I'm doing is I'm saying, let's test this under different assumptions on revenue growth. So there you see 15, 20%, 25%, 30%, 35% revenue growth. So if you plug these numbers into this revenue growth here, you're going to get very different revenue numbers. And you can see this is the 10-year revenue number of $222 billion. And at 35% growth, you get to a 10-year revenue number of $941, let's say pretty close to $1 trillion. I'm using a WACC of 10%. I'm using a terminal value of 7%, and then I'm assuming that what if Tesla can improve its operating margins from the current 16%, sorry, it's currently is 12.8, but if it can improve it to 16% or 18 or 20 or 25 or 28%, let's go and run the valuation model to see what happens. So here is the high road scenario. 35% growth in revenues for the next 10 years. Discount rate of 10%, terminal growth of 7%, increasing the operating profit margins to 28%, which is double the existing operating margins, will get you a valuation of $1,849 a share. At a 15% growth rate with pretty close to the existing margins, just a little bit better, you're going to get a share value here of $296. Here's a different scenario. I thought I'd do one which just changes the terminal value growth number, and of course what happens when you reduce that growth number, it's going to have a significant impact on the terminal value calculation. So I wanted to see, assuming the same growth rates and the same WACC, if we just took the edge off the terminal value, we would get to a valuation of $1,182. So you could say that perhaps at the real low end here, 15% growth, lower terminal value, and maintaining a little bit higher margins than their current margins, this is a valuation for Tesla of $202. And at the best case, 35% growth in revenues for 10 years, increasing their operating margins to 28%, you could make a case for a valuation of 1,849. All right, so where do I stand on this? Well, I'm gonna come back to the numbers that I have on the screen. And I'm simply going to say, if the current share price is at 994, or maybe a little bit under that, it's closer to 950, this is the scenario that Tesla must achieve in order for that share price to be a fair reflection of the value of the company. Now, to get to $670 billion of revenues in effectively 10 years' time, that would mean Tesla is double the size of Toyota and has about 25% market share of the auto industry. That is a hell of a growth curve. I mean, that's just monumental. And I can't accept that Tesla can achieve that. I think the hope and the wish for the green technology that is promised by this is somehow, I would say, deluding people to think that Tesla can grow by 30% per annum for the next 10 years. Man, I'm the first one to wish that I'm proven wrong, but I think it's highly unlikely. Highly unlikely. So you might say that what is more reasonable? Could we say that Tesla could grow at 20% per annum? In which case its share price is perhaps $444 based on an 18% profit margin rather than growing to a 22% profit margin. Yeah, I mean, I would be more comfortable with that. I would say, gee, even 20% growth for the next 10 years is a hell of a stretch. So there you have it, the valuation of Tesla. You have to choose where you want to pin the tail on the donkey, as they say, to determine whether you're a buyer or seller of Tesla at the share price. I find it very difficult to accept that this sort of growth, and growth, not only growth in revenues, but growth in operating margins, is something that can be achieved by this company. So we'll leave it there. I hope that you got some insight into Tesla. Over and out.